Hey everyone, welcome back to Corporate Decoder, the place where we decode the complex world of corporate finance and turn yesterday's filings into tomorrow's insights. Today we're diving into Corporate Standard Holdings Incorporated's latest report, and let's just say they've been busy securing their future. Maybe with a little help from some new debt. So what is the big news from Cooper Standard Holdings Incorporated? Or as we'll call them, Cooper Standard. Well, on the 20th of February 2026, they announced they're raising a hefty sum of money through a private offering. Their subsidiary, Cooper Standard Automotive Incorporated, is issuing $1,100,000,000 in what they call senior secured first lien notes. Think of it as borrowing a massive amount of money, but with a promise to pay it back by 2031 and with a fixed interest rate of 9.250%. This is a significant move to fund operations or specific projects, and it is being done privately, meaning it is not available to the general public but to specific types of investors. Now, a crucial detail here, these notes and the promises attached to them have not been registered with the Securities and Exchange Commission, or the SEC, and they won't be moved into the public domain through standard registration. This means they can only be sold to sophisticated investors who meet certain criteria. Like qualified institutional buyers in the US or specific types of investors outside the US, this is a common practice for large debt issuances to avoid the lengthy and costly registration process. It is not an offer to sell these notes to everyone, but rather an announcement that they are being offered under specific exemptions. Now, let's look at the risks Cooper Standard is navigating. The company is clearly concerned about its ability to keep prices competitive, especially when commodity costs, meaning the price of raw materials like steel and plastic, are going up. They are talking about needing to negotiate with their customers, the car makers, to pass these higher costs along. This is a constant balancing act in the automotive supply industry. If they can't get those price increases, their profit margins shrink. This ties into what they call escalating pricing pressures. Essentially, car manufacturers are always pushing their suppliers, like Cooper Standard, to lower their prices. So it is a tough environment where Cooper Standard needs to manage rising costs while facing demands for lower prices. It's a double whammy. And it is no surprise then that they highlight their substantial amount of indebtedness. This new debt offering adds to their existing borrowings. Having a lot of debt means they have to pay a lot of interest. Higher interest rates, which have been a theme recently, make that debt even more expensive to carry. It's like having a big mortgage with rising interest, making it harder to focus on other things. Another point to watch is their possible variability of our working capital requirements. Working capital is essentially the money a company needs to run its day. Today, operations think paying for raw materials before they get paid by customers for the finished product. If this working capital requirement fluctuates wildly, it can put a strain on cash flow, making it harder to manage operations smoothly. We also see them flagging modern threats like cyber attacks, data privacy concerns, and disruptions to their information technology systems. In today's world, a major cyber attack could be devastating, not only halting operations, but also leading to massive fines and reputational damage. They're admitting that keeping their IT systems up to date and secure is a significant challenge. So let's put on our Warren Buffett hat for a moment. Cooper Standard is a player in the automotive supply chain, and they've just taken on a significant amount of debt. The 9.250% interest rate on nearly $1 billion is not cheap money, especially when paired with existing debt. This new debt is likely aimed at strengthening their financial position and perhaps funding strategic initiatives in a challenging automotive market. The company is clearly aware of the intense pricing pressures and the rising costs they face. Their ability to navigate these pressures by successfully negotiating prices with their customers will be key. The risks they've outlined, from escalating pricing demands to the ever-present threat of cyber incidents, are not unique to Cooper Standard but are significant hurdles for any company in this sector. The substantial indebtedness is a major red flag. While debt can fuel growth, too much of it can cripple a company if revenues falter or interest rates climb. The direction of the company seems to be leaning towards securing funding for stability and future growth, but they're walking a tightrope. The success of this private offering will depend heavily on their ability to manage costs, maintain customer relationships, and ultimately generate enough cash flow to service this new significant debt load. It's a calculated move, but one that comes with considerable risk. Alright, that is our breakdown of Cooper Standard's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description for more exclusive content and discussions. Thanks for watching. See you next time.